But, okay, so on our show today, we just got released a couple days ago, the Fraser Valley Real Estate Stats. It is our stat show, the first show of the month. Yes, it is the first show of June 2022, and we will do that on our second segment because we are going to first talk about how the Bank of Canada just raised their interest rates again. We knew it was coming in June, and now there is the release. It has happened. We're going to talk about that, and we're going to talk about also Canada house prices. How far could they fall? What are we all talking about in the industry today? What's the talk of the town kind of thing? And so we're going to talk about that first. So first, I wanted to actually read out an article from the Canadian Real Estate Wealth magazine. It's one that I subscribe to, and it's a great article about Bank of Canada raises interest rates to 1.5% and what it means for your mortgage. So, at the start of the year, amidst rising real estate prices and ballooning inflation, a hike of the Bank of Canada's key interest rate seemed like an inevitable. Now, nearly 6 months down the line, and with multiple hikes behind us, hikes seem like a regular occurrence. It really does. Today, the central bank has made it clear they intend to remain on course and continue to increase its rates even further. This week, the Bank of Canada announced an increase to their policy interest rate of 50 basis points. Now, I should say this article just came out yesterday morning. So, the total amounting so far for the year is 1.50 because they did 0.25%. This is 50 basis points now. That means interest rates are now 6 times higher than they were at the start of the year, though they still remain below pre-pandemic levels. So definitely got to keep that in context. The bank has also announced they plan to continue quantitative tightening, the QT, a program under which the bank will allow the many bond holdings accumulate during quantitative easing to mature without replacing them, which will drive bond prices down and put upward pressure on bond yields. The policy interest rate affects the price of borrowing in many different areas of the Canadian economy. The current hikes are primarily a tool to help curb inflation, which hit 6.8% in the month of May. Most importantly for our readers, the interest rate plays a big role in how mortgage rates are set. So what happens when the bank raises its rates to you? Well, the Bank of Canada notably does not take on regular Canadians as clients. Instead, they're mostly involved in influencing the major banks and directing monetary policy. This means the first effect of the bank raising its policy rate will be an increase in the cost of borrowing for banks and financial institutions. Canadians can expect the cost of borrowing from banks and financial institutions to rise in a couple of days if it hasn't happened already. This increased cost will be passed on to consumers in the form of an increased prime rate. The prime rate serves as the foundation for many consumer interest rates, including some mortgages. So how does it affect your mortgage? Well, the Bank of Canada policy rate plays a major role in how banks determine their variable interest rates. Fixed rates, on the other hand, are more closely tied to government bond yields, which will be affected by the ongoing QT program. So the good news is that if you have a fixed rate, your interest rate won't change until your mortgage is up for renewal at the end of the term, or if you decide to refinance. But depending on when you started your mortgage term and when you were up for renewal, an increased interest rate will affect you differently. Those who began or renewed mortgages amid the record low rates of the last 2 years will see the biggest increase in interest when it comes time to renew, while mortgage terms that started prior to 2020 may not see as large of a change. For variable rate mortgages, though, your interest rates will be rising shortly if they haven't already, and will continue to follow the policy interest rates as it moves upwards. While variable rates were very popular during our previous low-rate environment, these borrowers will quickly feel the burn of rising interest rates. Many may choose to convert to a more stable fixed rate to ride out the shifting market. So I talked with a mortgage provider just a couple days ago and asked, So are you seeing people now going into more terms because of the rate hikes, or do you still see most people going into variable rates still? And she said that she's still seeing the trend of going into variable rates, and she still sees that the long-term and short-term, that's still better than the current 5-term and 7-term and 10-year rate, just the term rates. So that is the information about that. And then they go on to say how much further will they go, though. No one but the Bank of Canada themselves can definitely say just how far rising interest rates will need to go, though analysts are predicting more still to come. And again, the mortgage broker I spoke to says that if the inflation doesn't go out of hand, going out of hand, then they shouldn't raise it again this year. But if inflation continues to be an issue and a problem, they will have no choice but to raise interest rates again. So despite the recent hikes, the rate of inflation has continued to go up in recent months and is predicted to continue to rise even further before it falls, is what the article says. Clearly, the bank must still do more if they hope to rein in inflation. Yet, even with the rapid increases we have seen, they must still try to avoid moving too fast. Our current interest rate is still below pre-pandemic levels, though it is higher than it was for much of the 2010s when inflation hovered around 2%. And looking even further back, we're still far from the highest interest rates ever seen in Canada. Though comparing with the past, it is not apples to apples. So looking forward to the rest of the year, many economists are predicting yet another 50 basis point increase in July now. So that's pretty big. And while RBC Economics forecasts a policy rate of 2.5% to end of the year. So with just 4 potential hikes remaining on the BOC's 2022 schedule, they will need to continue at a pace of at least 25 basis points per increase to hit that forecast. Based on their recent clip, that seems more than doable. So that is what's happening with interest rates currently and the foreseeable future. And so overnight rates versus prime rates. That is another explanation that we can go in a little bit. But if you want more information of that, I do have good connections to great mortgage providers. I'm happy to give you their name, and you can ask them all the questions, as I always do. And I do get rate cards every time there's a difference in rate hikes and any discounts that some of my mortgage providers offer. And I do share some of that on my social media if you want to keep an eye on that. And I'm happy to share those with everyone as well. But if you wonder what is the Bank of Canada, well, the key to understanding how interest rates function in the Canadian financial system all comes down to the Bank of Canada. And the Bank of Canada, not to be confused with the Royal Bank of Canada or the National Bank of Canada, which are completely separate entities, it's a government-operated bank that serves as the Central Bank of Canada. And the Bank of Canada has been the nation's official central bank since its creation in 1934. And its stated goal is to promote the economic and financial welfare of Canada. So that is what the BOC is, the Bank of Canada.
Very cool. Now we have the full explanation.
Yes, well, mostly.
All right. Well, I guess we're getting to the point where we probably should take a break here. But if people want more information about what you do as a realtor and all the stuff that comes with it, because I know your website's chock full of stuff, where can they go?
MicheleCummins.ca.
All right. We're back with more right after this.